Welcome, everyone. Thank you for joining us for this month's State of Freight webinar presented by Triumph. My name is Brittany Chisnall with the FreightWaves media team, and I'll be your host for today. As always, I'm happy to be joined by FreightWaves founder and CEO, Craig Fuller, and SONAR's head of freight market intelligence, Zach Strickland. Today's conversation will cover the latest insights from SONAR, current market trends, and insights from our experts. Craig and Zach will also be answering your questions live following our discussion. Before we get started, I'd like to cover just a couple of quick items. First, if you have any issues during the webinar, please feel free to reach out to our team via the group chat function in your webinar console. If you have any questions that you'd like to ask our experts, please enter those through the Q&A box in your console at any point during our conversation today. We will answer as many of those as possible during the live Q&A. We'll also be sending a link to the recording of this webinar tomorrow if you'd like to view it on demand or share it with your colleagues. At this point, I'll go ahead and turn it over to Zach to kick off today's discussion. Zach, let's jump right in.
All right, thank you so much, Brittany. And welcome to this month's State of Freight, September. Normally this time of year, we're talking about the weather and hurricanes. It's a little quiet this year, though. But I think
the hurricane season has been unusually quiet.
Yeah, but I think we still have enough economic turbulence that
it is interesting because it feels like macro data is starting. I mean, I think probably the most telling data point that we've gotten, sort of macro data point that we've gotten in recent months has been the jobs reclassification, like the massive revision of BLS jobs, because that's what everyone said that was holding on. And every time you got into a discussion about the economy, everyone said that, well, jobs, and it's pretty clear that that number was not correct.
Yeah, JP and I were talking the other day about the jobs figures and how revisions are quite normal, except this one actually was
substantial,
extreme.
I mean, you're talking something like just the amount and the depth and the fact that it went on for a long time. And I've heard different explanations on how they got there.
Right.
One of the biggest sort of more credible explanations has to do with the government job sector, and the fact that, believe it or not, no one's shocked by this, government reporting is so delayed, and there's been so many changes in particularly the federal government and then sort of the follow through of the states that it's gotten that number wrong. But the revision is incredibly substantial. But it's interesting, the ADP, people have gone out and attacked the ADP report, but it actually looks like two different surveys. One is using ADP's data, one's using government data. The ADP appears to be directionally correct.
Well, it's private focused only.
It's private, correct. But it also has a faster, newer, cleaner methodology than a lot of the BLS does. We've been very publicly critical, and I think rightfully so. Government data is flawed, and particularly a lot of these methodologies are 50 to 100 years, been around forever. A lot of it was sort of post or like 1930s when they started to build some of these data sets. I mean, some of these methodologies are that old, and they have modified them, but they haven't overhauled how they do it. And there's much better, higher quality, high frequency data, which oftentimes conflicts with some, particularly when you have a change in the economy, conflicts with it.
Yeah.
But I think that tells us that the economy, or at least the jobs numbers, haven't been as strong. And there's been a lot of structural weakness. Now, the weird part is to watch the stock market do what it's doing.
I mean, and that's another mechanism entirely. Like the investment and money flow in this country is heavily concentrated in the financial sector right now. But I think the goods economy is clearly what we focus on.
The goods economy is so tired. I mean, people would call that the Main Street economy. What we care about is the goods movement in there. And Cass's report came out, I believe it was yesterday, where it talked about the volume of shipments. Their indices are effectively three types. There's the cost, the volume is one of those, and it was off by 9%.
Yeah.
No shock to anyone who's that pays attention to what we've been saying. We're looking at on SONAR's data down 15%. Cass's shipment data is down 9%, but a lot of the fallout in Cass's data, which is a breathtaking loss of 9%, A lot of it was the LTL collapse, is the LTL market collapsed. And LTL is far more exposed to industrial. I mean, as a market percentage of the LTL business, it has a larger exposure to industrial than truckload does. And I think that tells you what we've been saying is that the manufacturing economy has been down. Auto is struggling, as well as housing.
Yeah, I think it's been pretty clear cut in our data, at least. It's been kind of a breath of, I don't want to call it fresh air because it hasn't been exciting in terms of demand stimulus. But if we pull up the OTVI, I think you'll get a big picture of, a better picture of what we're talking about here. Like, this is just truckload tender volumes only. And of course, CAS measures LTL, intermodal, and a few other modal volumes there. This is just purely truckload volume. So you've got flatbed, refrigerated, dry van, primarily sitting in this index here, and it's down dramatically year over year. Now,
it has been. And one thing to know about CAS's data, and CAS has got an amazing data set.
Sure.
But their data does have a bit of a lag compared to the high frequency data. It's invoices data. And so being invoice data means that and anyone who's ever studied truckload billing cycles is these invoices come in when the carrier, the provider bills them. And sometimes it can be, weeks after, if not
months.
And so you get this lag in CAS's data, which, the tender data has been telling us since really February, but even if we look at the OTVI chart right here, I mean, we had a pretty marginal summer, but it wasn't a collapse, right? And what we have seen really since July is a really substantial collapse in freight volume. July beyond has been rough. And I think that's what CAS's data is. We're starting to see the July number show up, and some of the softness, the weakness is there.
Yeah, something that I wrote about this in our daily watch that SONAR subscribers get today is looking at pure demand side figures can be a little misleading because some people are, out there that I've talked to have been like, it's not as bad as that aggregate figure suggests. And I'm like, well, okay. That's also because that you're not necessarily feeling the supply side conditions.
Well, this is the difference, right?
Yeah.
Is like 2 years ago, everybody was talking about how abysmal the trucking market was, the freight market was. And it actually, if you look at the OTVI number, it wasn't that bad.
Right.
But the reason it felt so bad is because of the tender, there was so much capacity in the market. The market was flooded that tender rejections ended up hitting 2.5% in May of 2023, right? Was the low of the market.
The bottom of the market.
The bottom, and that was
for tender rejection.
That was the miserable piece, but the volume data didn't.
Volume was still there.
Volume was soft, but it wasn't. It had sort of recovered from some of the lows of 22, but we were still dealing with a sluggish market.
Yeah, OTVI is actually mirroring 2018 levels, which
it's insane.
Which people are they're like, well, 2018 was a robust freight market.
But you can't lose 7 years of economic growth and think that's a good thing.
Right.
I mean, the truth is that none of the volume data, OTVI included, should ever revert back. It's like having in a business where you're like, oh, we're doing better than we were 7 years ago. Like, how is that something to brag about? You've lost 7 years of compounded growth.
Yeah. Also, in 2018, that 10,100 figure, 17.5% of that at this point in time was being rejected.
Yeah. So it which means you have some increase. But the point that I'm making is, like, even going back to 2019 levels, which is where OTVI was
not that long ago,
2 weeks ago, you're talking about 6 years of no growth.
Yeah.
Like, we should all be worried about that.
Right. Well,
and it's not just trucking. I mean, you see it in the box reports. I tweeted this. I think you and I may have spoken about it, was the whole packaging material industry and the fact that volumes in the packaging material were down to 2015 levels. Like, the economy, the freight economy is not doing well right now. And I think we have to, look, Moran's, he was president, he's now part of the Federal Reserve. He's still the national economic advisor for the president's economic advisor. He's right. I think 50 bips, we needed that. But he was the only one that voted for 50 basis points yesterday. It was a sort of a contrarian take. probably looked from the public standpoint politically influenced. The reality is that if you care about the Main Street economy, we need structural change to really get it. We need lower interest rates, lower borrowing costs, and we got to fix this housing problem. Housing is the primary reason we're here. Housing and auto, because they're just so important.
Yeah, well, structurally, housing, of course, we've talked about it in the past. It's not just the framing of the house, it's the finishing, it's all the stuff that goes into it.
It's the appliances, it's the TVs. You know, when people move into a home, they tend to replace out furniture. Sherwin-Williams, I don't know if you saw this, eliminated their 401k for all their employees because of the softness of I mean, Sherwin-Williams is, I believe, they're the largest paint manufacturer in the world.
Right.
I believe that's the case. Certainly not an industrial, but a consumer, residential, commercial. They eliminated 401k because of the softness in the housing market. I mean, they're seeing it. It's you know, the housing market is such an important barometer and such an important driver of freight activity that it happens in the front end with builders. It happens with the materials that go into the home, like I said, carpets and drywall and wiring and plumbing, fixtures, and all that stuff. And then it happens when somebody moves into that house. And you effectively, when someone moves, you actually get a twofer because they are moving somewhere new to them, and they're fixing their house and changing the house, that wherever they're moving to, they're doing it the way they prefer. They're either tend to be to buy a bigger home or downsize. Like that tends to be when people move, they move for a reason. And so you get some impact of cells and products that go into those homes. And then the new person that comes in your house is doing the same thing. And so you get a twofer. So the housing market is so important.
Yeah, and of course, starts and permits were both disappointing reports this past week.
I mean, the problem is builders. I mean, everyone's like, why is the housing market so tough? First of all, it's price discrepancy between what people can afford and where home prices are at. A lot of it has to do with zoning laws have really impacted.
Well, inflation during the pandemic put a lot of.
I don't think people realize how important the builder sentiment is, because builders and the bank willing to lend.
Right.
Builders are uncomfortable because of the 2008 lesson of being stuck with a lot of unsold inventory. So they're not building. And this, if you think about this from a freight standpoint, what we have to do is get builders. 25 basis points is not going to get us there. Like, first of all, the 10-year didn't drop much. It dropped a little bit. SOFR has not dropped. And so
they already priced that into the bond market before that even happened.
Yeah, I mean, the bond market is definitely in charge. But the reality is that, and then I think the Federal Reserve, in my opinion, did a pretty big disservice because they came out pretty inconclusive yesterday about whether they were going to continue to ease.
I thought they were talking. I think they signaled another cut.
There was the dot plot, a lot of disagreement in the data, and a lot of the sort of conversation on Wall Street is uncertainty about where do we go from here.
Well,
is this going to be?
Inflation.
Is this a continuation? Is this a start of an easing cycle? Is this going to be a wait and see situation? And I think from at least what I picked up, I didn't see the direct press conference, but I saw some of the notes from some of the banks. The notes that I read basically were talking about the fact that this is a wait and see data. Basically, the Fed's quote unquote data dependent, and they're going to wait and see, and a lot of uncertainty about forward rate cuts. Now, I think Wall Street is priced in 2 more rate cuts. Those were already priced in. I think what Wall Street wanted to see, which they didn't get, was some a dovish Fed saying we are going to start this process through an orderly decreasing of rates, and they just didn't get that. It seemed like almost like a very cautious set of statements.
Are we putting too much emphasis on the Fed cutting rates, though, in terms of freight demand and volume and investment?
I don't think so, because it strikes me that the Fed is the primary reason that we don't have a vibrant freight market. It is. Look, we can talk about tariffs, but tariffs have not created the inflation everyone thought they would. Like, there has been some wholesale price inflation's up, but consumer prices aren't seeing it.
In aggregate.
3%. You're not getting the 7. I mean, we have tariffs that are at like combined. I think the average tariff rate is like 18.
Well, Jerome Powell talked about it yesterday, and the way their data reports it is a lot of the inflation was actually being held in the middle of the procurement,
but
before they
the
get to the
consumer
consumer
prices. Look, it's people are going to at me here in a minute. There's been inflation. Yes, there are certain products that are seeing increase in prices. Absolutely. Big box retailers that we talk to in my daily capacity have said there are increases that they're seeing in cost, and they will eventually cycle to the consumer. I'm not taking that away. I'm not discounting that at all. But if you go back to where we were in April, and people were talking about catastrophic levels of inflation, where we would have runaway inflation of double-digit inflation on products, that has not shown up in the data. We're at 3% inflation year over year. The most of the inflation has been on wholesale prices, not on consumer prices. And the things that tend to drive the predominance of prices from the Federal Reserve's perspective, the whole inflation index is energy. Energy prices are down. Food. We produce the vast majority of our food. In fact, we've lost our export markets to places like China. Like soy is.
We've got a surplus.
We are building a massive soy surplus. It's because they're not able to sell it. There is downward pressure on food prices because we have lost our export markets. And so housing is the one thing that actually is creating such a drag on both inflationary numbers, because it's the housing, the rents cost are higher, and there isn't a lot of new supply coming on the market on new homes, which is keeping prices artificially high. And so it's the stuff that frankly isn't tariff driven that ends up driving a lot of the quote unquote inflationary impacts that we're seeing at 3%. A lot of that has to do with labor availability in blue collar jobs, which you could argue immigration has been a big impact there, and related to the cost of housing. Those are the two primary. Insurance costs, healthcare costs are up.
What about
education costs are up?
What about the labor market's influence?
Well, that's what I'm saying. Okay. You can look at that, but that's not a tariff-related issue. That is if anything, the tariffs have slowed the economy down. And if anything, they have created some level of downward pressure because of the lack of demand. Companies have not been able to pass on higher prices, which is why the wholesale prices, I think it's something like 75% of the increase in price is being felt by other countries, but through either currency changes or concessionary prices that they've offered U.S. suppliers. Then it shows up in U.S. prices, and they absorb something like 15 to 17% of it. And the consumer's seeing a very small piece of that today. I'm not saying that won't happen in the future. It could be 6 months from now, we could see prices. And I'm not saying there aren't to that, because there clearly are. But generally, consumer prices are not being impacted by tariffs to the degree that other things are driving higher inflationary impacts. Labor supply in certain job categories, particularly blue collar jobs, really, really struggling to get supplies of people that work the factory, that work the farms. Even in construction labor, this is one of the reasons the housing market is sort of abysmal, is construction labor is not available. And so those are things that are certainly true. And that has a pretty big impact.
What about, let's go to the freight market a little bit here with the import demand wave that we saw kind of occur because of a lot of the tariff implementation activity. And I want to get your take on the IOTI, which everyone's looking at right here. So, we can get stuck in that whole inflationary, aspect rhetoric here, but I want to get your vibe here on what exactly you read when you look at the IOTI nowadays. When we saw this, there was clearly a little bit of a mini pull forward at the end of March that's a little out of season, or a little exaggerated seasonality. And then we had that unnatural downturn in May, which actually did have a little bit of historical seasonality to it. But that was, of course, the 145% on China. Then we had a recovery, which led to an early peak season. And now we're down. What's your read here?
I've got a 6-year-old who's learning a little bit of basic shapes and geometry.
Yeah.
let's cut off that mountain that took place in June and July, and let's stick it over there in that chasm.
Yeah.
Those charts start to look like, it almost looks like a continuation.
Yeah.
Like,
Just a flat line?
if you took it, it looks like you may have had a little bit more exaggerated levels on the expansionary part of that chart.
Yeah.
In July, June and July. Largely, a large piece of that is, I think, a lot of preparation. People were very nervous. But if you look at where we're at today, Zach, we are certainly lower than we were a year ago.
Mm-hmm.
But what I'm reading right now is what I would call stability. The chart from mid-August to where we're at is kind of boring.
Extremely.
And I think if you're talking international freight, this is what we want. I tweeted this yesterday.
Mm-hmm.
So I have media businesses that I run, including FreightWaves, but also I do aviation, marine hobby.
Mm-hmm.
September's sales reports, listening to feedback from our sales team, was the first time all year, really since February, we'll say, first time all year that every single one of the forecasts were higher than the pro forma. First time all year was we were getting positive feedback. And I want to tell you why I think this is really important. Is advertising is always the first to go.
Right.
Advertising is always the first thing to cut. It is usually the last thing to come back because people are, what tends to happen is when people get nervous about the economy, they start cutting out discretionary spending. Jobs are usually, they're reluctant to cut jobs because that is painful,
right,
even for people that are doing it. So they tend to hold off on things like that. They'll delay CapEx. Advertising is usually a highly discretionary expense that people are saying, I'm not investing in my business today for growth. I am simply trying to survive whatever the wind is. September was the first month I saw any sentiment shift in every single one of our groups. I think it's important because it's a big enough portfolio. It's quite diverse. It tends to be into luxuries, has a lot of luxury exposure. We also have hobby and freight. But I think it's telling me, and I'm talking to a lot of other CEOs that have talked in the recent weeks about how much better they're feeling about their business today than they have been. Now, it's interesting because we talked about the labor market being soft. We talk about some of the broader economic data being soft. But let's not forget that we're in freight.
Right.
Freight markets lead the broader economy by 6 months. And if we are truly starting to see, I think a couple of things are driving it. One is, I think strong stock market at some point has a big impact on psychology. I think the Fed saying they're going to cut interest rates and following through with a pretty small cut does help. We've had a big tax bill that will create some stimulus in the economy that is now starting to filter through. And I think we're over the whiplash of tariffs. It's not saying that there hasn't been, it's probably a tweet right now or a Truth Social about some tariff that we're going to apply, but I think the whiplash that we saw earlier this year is largely people have we've realized that we can survive all of that, right? Mm-hmm. And we're not seeing runaway inflation. And I think that's giving businesses more confidence in the future. Plus, any business owner who took steps to reduce costs is probably thinking, okay, now I can start to incrementally put some increase in my growth because it's not as bad as perhaps I had feared.
Yeah, I kind of wish I had put a few more years, or at least pre-COVID years, on the IOTI because it doesn't do it justice. I think 2024 and 2023, you can see 23 in the fuchsia. That was when inventories, I think a lot of companies were caught off guard with lower than expected inventory.
If you remember, 22 was the ocean recession that really started the second half of 22. But the freight recession we had, I mean, it's funny, I talked to people in ocean markets, I talk about freight recession, and they had their freight recession that lasted 9 months.
Yeah.
Ours has gone on for 3 years. I'm like, you guys don't even know what a real recession is.
Right.
In 23, it was recovering, right?
Yeah.
And so what we saw was a real strong recovery in 23, followed by 24. People were preparing for change in policy, change administration. It's hard because we can't go back into the mid 2010s and sort of see the same economy. The economy is very different. The world's very different than it was. 10 years ago. But this chart, again, I think you have a level of boringness that's happening now in September. And I think that's telling us that boring is good.
I mean, to me, like, and again, I wanted to point out that 2023 and 24 in the fall, the comps are going to be more challenging because we had almost an
We had a
overstimulated.
stimulus. I mean, you had an election coming up,
Yeah.
and everybody was preparing for what I think most people in supply chain were kind of aware that there was going to be a more likely outcome of a Trump victory than it perhaps appeared earlier in the year.
But I would encourage everybody that has a SONAR subscription to look back, and an 1800 on the IOTI isn't a bad number. It's certainly not recessive in terms of overall bookings.
No, I truly think that the economy, the freight economy is bad.
Yeah.
The Main Street economy is bad.
Sure.
But it strikes me from what, again, just one person's opinion, but enforced with, I talked to a lot of CEOs in business. I look at my own business, and I look at what we're seeing in, a friend of mine runs a large consulting business tied to logistics. I talked to them yesterday. He goes, we've never been more busy. Now, this was a year ago. They were talking about how distressed they were.
Yeah.
There's M&A activity happening. There's companies willing to make investments in their business. They're thinking differently about it. It's not in the data yet, and we're probably going to get a couple bad quarters of economic data coming. I believe that's going to be the case. But all I'm saying is it certainly feels like the worst we've already experienced it, and we may be coming out of it.
I think you're right. One of the charts, the tender rejection chart, which I'd like to pull up now, for the freight, the transportation.
I want to be clear, so nobody misconstrues what I'm saying. I'm not bullish in terms of where. I'm not like we're out of the recession. I'm not doing that anymore. I want to be clear. I'm not saying we're done. I want to be done. I'm just saying the sentiment that I think most people that I speak with that are not
turning
is certainly business leaders are starting to see signs of strength in their business.
Sure.
They're starting to see that things feel a little bit better.
A little bit better. Well, things from the tender rejection rate standpoint, from a very slow perspective of growth year over year over year, have been slowly increasing. And I think we were talking about, and we've talked about this the last couple of times on State of Freight, how demand, especially the tender volume index, down 15% for the last couple of months on average. But tender rejection rates have been remarkably resilient.
Well, it's because of lack of capacity.
There you go.
So we are setting ourselves up, if we can get true volume recovery, and it's an if at this point. Who knows? If we can get volume recovery, tender rejections are signaling to us that despite the super softness that we've seen in the third quarter of this year, despite that, there has been some balancing in the market in terms of capacity, that we're not seeing an epic collapse. I mean, look at it. It gets below 5% that we saw in sort of late April, which is at the height of the tariff instability.
Right.
Things have normalized since then in a range of 8% being the high, 5 to 8. It just, what I'm reading into these charts is that we have a lot of support at that 5% level. And it is certainly suggesting that we are in much better shape today as we get volume coming into the market, that things will potentially recover for carriers.
What do you read on the rest of the year here? I mean, the last year's peak season would suggest.
Well, you had all those imports last year.
We're on track.
You had all those imports last year.
Yeah.
You had a lot of import stimulus coming in. You had more bullishness. Remember, this was I think everyone was sort of relieved that there was not going to be it felt like it was going to be a massive contested election. 24 economically was a pretty good year from the GDP standpoint. There was a lot of stimulus being put into the economy. It's interesting because the labor market was not as good as we think it was.
Right.
We hoped it was last year. But there was still a lot of money pouring in. I think a lot of the sort of stimulus was hitting the economy that had been put in under Biden's policies for the last 3 years. There was a desire to sort of ship all that money out. Is it possible that we would have a strong fourth quarter if we could have a green line like last year? Certainly possible. I I would say I'm as inconclusive about the direction of where we go over the next 90 days as I've been.
Really?
And I know that I feel like I'm like all over the place today. I would say I'm generally bullish that things aren't getting worse,
Sure.
but I don't know how fast things will recover. That's what I would say if I had to boil down my conversation.
I mean, to me, when I look at the tender rejection index, that's kind of mirroring what you're saying. It's a little bipolar.
It's not great. It's not great.
It's a little
range.
erratic.
It's a little range bound.
But I think there's messaging here in the fact that it does have such erratic movement in it.
It does, but it also stays range bound, right?
Yeah.
It's that 8% on the high end, low percent on the 5%. We're on the lower end of that. We've had a lot of imports come in that are not yet deployed into the freight economy. We could see a good fourth quarter, but I'm reluctant to say that it's here. And I'm reluctant to even say that we will have a good fourth quarter because I don't know. But I don't think things are getting worse.
So I want to ask you this, because you've got a book coming out.
I do.
And you did a lot of research on supply chains.
I did.
To go through this. I think, yeah, there it is, right there. And I'll let you talk about it here in a second. But in all of your research that you did for this book, it's coming out in October, right?
Yep. October. And by the way, if anyone who comes to F3 we'll get a copy of it. We'll have the opportunity to get a copy of it. So we'll have copies for anyone that comes. We're also going to have pre-orders. Hopefully by the end of the week, we'll get that up and running. You can pre-order it.
Is there anything in your research that gives us any kind of semblance of a playbook of this type of environment?
You know, it's interesting. I did a lot of this is sort of moving the world is really so one of the things I get asked a lot by people who take a job in freight is like, what should I be reading?
Right.
This is people don't have experience. And my goal here was to provide a comprehensive overview, not to go too deep on any one topic.
Yeah.
Because the supply chain, the freight market is so big and so expansive, I wanted to really touch on almost every major mode of traffic and some history on how these things came about and how they sort of interact. But one of the things I think was really interesting was I talked a lot about the cycles, and I went through all the major freight recessions that have really taken place, provide some context of what was the backdrop of it and where we got. It was interesting. I did this section on comparing trucking versus ocean freight cycles and just why they're so different. And I think one of the sort of things is the ocean market is a far more constrained market, obviously. But the reason that when things get bad in the ocean market, they historically have gotten so bad is because they're so fragmented. They were so fragmented that we're unlikely to see any kind of ocean market collapse at any time in the future because of that high concentration. These $200 million ships that it costs.
Right.
3 years to build a ship at a cost of $200 million is a massive moat around expansion. And so they have so much more power over pricing than we have in trucking.
Right. But have you ever seen anything, like, did you see anything historically that would say like, hey, this market or this environment, I mean, we've had plenty of distractions.
Nothing like it. But I didn't go too deep into I went into the cycles and the backdrop of how we got here. But since deregulation, this has certainly been the loosest market, the most weird market. But a lot of it is the labor supply. I mean, a lot of it has to do with, and I truly believe this, and is the I didn't cover this too deeply in the book, is we are well past the days of a perpetual driver shortage. Like, maybe there was the existence of the driver shortage 20 years ago.
Yeah.
But that doesn't exist anymore, and it's sort of a myth that I dispel in the book. But also, the reason we have such a glut of capacity and we've had such really just this nasty environment is that during the downturn in 2022, for nothing more than just survival, and I'm not condoning it, I'm not endorsing it, but a lot of those operators, just to survive. And I don't know if I was staring at bankruptcy and I was gonna lose my house, my life savings, I don't know that I would have done anything different. But a lot of those operators ended up bringing on drivers who did not have proper work permits and did not meet the English language qualification. A lot of data to support that, as many as 150,000 drivers. That is what has kept the market oversupply of capacity.
Right.
That is a fact. And that was one of the things that I think is pretty telling in all of this. And that's what I do go into the book. But really, I just want to be very clear. My book is meant to be a primer for all sorts of context.
Breadth.
It's very wide.
Yeah.
I go back and talk about some of these ancient transportation systems and how they exist in the grains. I dove deep into like the Postal Service. Fascinating stories about the Pony Express. 18 months. It lasted for 18 months.
Right.
The Pony Express, arguably one of the most iconic transportation networks in history, lasted 18 months. And so, anyways, it's meant to highlight all those major stories. I actually deleted probably 100 pages of content and some chapters I found really fascinating that were kind of diversions.
Right.
I did this whole thing on the power of air conditioning, like the heat pump.
You went down some rabbit
I went
holes.
cold chain. It was this whole thing on cold chain. Yeah. And I just became so fascinated with the impact of air condition on society.
Right.
And particularly like population movements and stuff and disease. Fascinating chapter. It got deleted because it was such a diversion from the core piece of freight.
Right. You needed to maintain some focus there.
But that comes out. I appreciate you asking.
Yeah. So capacity, we talk about. You just mentioned it. It's still leaving the market.
It's so easy to hire. It's been so easy to bring on new participants in the market. Yeah. And look, I blame the government for allowing the states to issue. First of all, when the Obama administration loosened up rules, and they did this encouraged by a lot of the trucking interest, wanted them to loosen up rules and basically allow for labor supply to come into the market. Because the thinking was we have a driver shortage and we need to bring new drivers in. But when they did that, what they actually ended up doing is creating almost a two-class system with trucking, where the big guys weren't hiring, people who weren't qualified because they can't, because the insurance companies won't let them do it. But then those smaller carriers, the ones that are truly fighting for survival, did. Mm-hmm. And in doing so, it just exacerbated the excess capacity. And what has also really happened is the impact of a lot of these owner-operator models, as well as brokerage proliferation, has also enabled some of those backdrops to go.
Well, looking at the net revocations data, now this is, of course, based on FMCSA data. Carrier Details does some extra work for us to help clean it out a little bit faster, but typically we see exits happen at a slower pace than entrants. So we're always kind of running this net surplus. However, we're seeing this, we saw this acceleration, which is seasonal at the end of every year, where January and February, December, that's the time where a lot of people jump out of the market. We're seeing some pretty erratic signs that this exodus is continuing now.
I think a lot of this actually is the administration's changes in
look at these
policy.
spikes.
I mean, look, the administration's got a lot of things wrong. One thing I think they're not wrong about is was really cracking down on some of the regulatory constructions around who is qualified to drive a truck.
Yeah.
The ELP data, the English language proficiency issue, is a safety issue, but when you tell people that you don't require someone to have a work permit and they can drive a truck, all that does is make it that much more attractive for people to enter the industry who don't have proper work documentation, have not passed a CDL to drive a truck. Mm-hmm. It's natural. That is on the government. It's not on the operators.
Right.
It is on the government. And that is exactly what happened. And that's why I think you're starting to see a lot of these regulatory changes are actually going to have an impact and are going to continue to show up in the data. And you can see that really since, it was June, it was really over the summer when the DOT secretary came out pretty direct about trying to actually enforce these rules.
Yeah, and I think one of the reasons we see the tender rejection rates so erratic, I mean, some of the stuff, I look at this stuff at a granular level every day, and the thing that I always look for is what's moving the rejection rate, in individual markets? Is it refrigerated? Is it dry van? Is it flatbed? What's making this happen? And the answer has largely been erratic. Like, it's not like it's coming all out of Ontario, California, where the port volume, you talk about the
A lot of
import
these
flows.
carriers are, I mean, look, they're facing their own challenges. I mean, the interesting thing is that for the most part, most trucking companies on a per mile basis are losing money. Here's the thing you should know, Zach, is that this is not just my words. These are words from some of the bankers that have studied it. It's coming from the data, is that almost every mile a truckload carrier operates, on average,
Right.
they're losing money on that freight on a per mile basis. You worked in pricing, you know this. Now, they can do that for a long time because they're covering their variable costs. And you got to remember that 40% of your cost in the trucking business is fixed.
Yeah.
And think about the payment on the truck. They're losing mile when you look at all the miles they do, but they're generating cash flow. And until they have to replace the truck or deal with maintenance problems, they don't actually, they're generating cash, but they're underwater.
Yeah.
And what's happened is that this freight recession has gone on so long that a lot of these guys have been losing money or losing equity, losing net worth, if you will, but generated enough cash to stay alive, that now that this has gone on now 3 years, a lot of the trucks are 5 years plus for these carriers. When they need to go buy a new truck, they can't.
Right.
And they can't maintain them, and then the trucks start to fall apart. They start to have safety problems, can't attract drivers, and they end up in accidents because when you stop maintaining a truck, it's going to become less safe. That's when we start to see a lot of the problems. And that's why I think the capacity is going to continue to come out of the market. And should we get some push in volume, and I mean should, I'm not saying we will.
That's the big question.
But should we get a nice fourth quarter and maybe into next year things will be better, then I think we'll start to feel it, and the shippers will start to feel it, and we'll be scrambling for capacity.
Yeah, I think we are already seeing some of the canary in the coal mine, mainly from a supply side dynamic. When I look at the maps that are in SONAR now, if we want to pull up, a new view of our
new
maps.
map.
Yeah, our new map.
A new mapping system. By the way, shout out to our engineering team for shipping product. Like every week, there are 3 to 4 new features inside of SONAR. It is really a completely different level of cadence to what we're doing, or what they're doing, I should say. One of the nice things about the maps, you can find them at the top of SONAR under maps. And this, by the way, it was already there. You just had to find it. It was hard to find. What's nice about it is being able to get into the data that you want to see right there. It defaults to the hull.
It makes my day a lot easier because I'm looking at WRI right now on the map, and that's what I use to kind of figure out where the rejection rates are moving the most based on volume and weekly change. But you can click on of course, the market there, and you get kind of a full read of the market conditions and what's going on there. But yeah, I mean, it's been a very wild ride. And of course, for a lot of the people in the space, they kind of rely on their own data.
Yep.
And, we also have the Blue to Blue app.
The Blue to Blue app is something you can download.
Yeah, that carriers out there, owner ops that are generally blind to the overall market.
There's a new update coming in about at F3. We'll have a new update. It will be great, quite great. And through that app, you'll be able to see which markets are blue.
Yep.
Go blue, and that's good. So that is now, you can go to the App Store, you can download it, you can get our pricings in there, track pricing, the SONAR pricing, spot pricing's in there. Tender rejections data is in there. It's great to carry basically on your phone because you don't have to log in.
Yeah, and you can figure out you can do what I do, and that's figure out where the opportunities are growing. So I want to know, we're getting close here towards the end. I want to leave some time for the Q&A. Is always exciting to get. So Brittany, I'll toss it back to you. Let's see what we got.
Yes, so now we'll take some questions from the audience. So if you haven't already submitted those, please type your questions into the Q&A box of your webinar console. We'll cover as many as we can in the time. Does look like we have a few questions so far. The first one, on the topic of some maybe not feeling the market downturn as much as others, Is there any data that speaks to volumes from the big box/Fortune 1000s versus the medium and small shipper community?
It's a great point. I'm glad that question was asked, because if you look at the earnings reports, the big box retailers certainly are doing well, and they picked up market share. They're in much better position. They have better negotiation power.
Yeah.
And they have just better networks. And so they're certainly winning relative to a lot of midsize. But most of the pressure we're seeing, even consumer spending data, I think in August, I believe we've had 2 back-to-back months of consumer spending data being better. I certainly know, I think August was certainly strong. I believe I saw something today that flashed. It was like 2 months of back-to-back consumer spending was higher. It is clear that that the retailers that tailor to consumers, particularly big box companies, are doing much better than the industrial sector. I mean, look, this whole downturn is really, it's really a housing recession, and it's an auto problem. And that seems like, okay, these are isolated, but combined, this is 30% of the trucking market.
Yeah.
Auto's a huge piece of it. A lot of it is sort of the whipsaw and law, and let's go EVs and let's go internal combustion engine. That had a big impact. It's the cost of autos. I mean, buying a car is insane. Like the price of a car, what you could have bought 5 years ago to what you buy now is huge. It's restrictive lending, and then it's housing. And that is what's causing the freight market to feel really soft. Big box doesn't tend to sell. In fact, you could go and look at Target versus Walmart. Target, for people who are more affluent, tend to shop more at Target for their housewares than people shop at Walmart. Walmart's predominance is grocery and consumer staples.
Yeah.
They don't sell a lot. They sell houseware and stuff.
Sure.
They don't sell a lot of stuff. Target has a larger percent of their sales go into what we would say is directly related to what you look at as housing, right?
Sure.
And so we certainly are seeing big box do better. And I think if you are a trucking company and you have exposure to consumer retail and big box, you're certainly in better shape than your friends that are hauling industrial goods.
Or furniture.
Or furniture, or flatbed for lumber.
Yeah. Definitely a more challenging environment on the flatbed side right now.
Yep. That's housing.
Yeah.
Awesome. Another question we have says, according to some FreightWaves reporting back in July, eliminating the de minimis exemption for low-value imports from China, Mexico, and Canada could add billions in new customs duties and paperwork for small shipments. How do you see this change impacting e-commerce supply chains and the freight companies that service them?
I'm glad that question was asked. De minimis is a huge impact. I did actually, in some ways, regretfully spent too much ink on de minimis in light of my book, because when I started writing the de minimis article, writing about it, I think it was in March or April, it was not clear that the administration was going to get rid of it. They were attacking China's de minimis at the time, but it wasn't clear it was a global thing. Now they've done that. They've implemented it. I mean, the de minimis exemption is always one that of all the trade policies, the one I had the biggest problem with, because it essentially allowed these foreign companies to compete against U.S. companies. And something like 20% of U.S. postal parcel volume was actually de minimis shipments of companies like Shein and Temu.
Right.
And it's amazing. Something like half of fast fashion was directly related to de minimis. So it is certainly adding billions of dollars in duties and tariffs. It is clogging a lot of the global postal services have actually shut off, or temporarily suspended, I should say, parcel volumes to the United States because they didn't know how to collect the fees and deal with the whole customs cluster that, customs is not ready, or I shouldn't say, has not been ready to deal with this volume. And you do hear horror stories of where somebody imports products in, say, April, and then I talked to a materials manufacturer that had this. They had a big import, and this is not de minimis related, something else, but a big import of containers that came in April, and they just got notice from U.S. Customs not more than a week ago where they had underpaid. It was tens of thousands of dollars in underpaid duties because it had been recalculated, reclassified. And that is a problem. What does it mean for e-commerce companies? I think it depends on where you sit on that. I think generally if I ran an e-commerce company, I'm actually probably excited about the de minimis change because
Most of them that aren't Temu and Shein.
well, I no longer have to deal with competition. One of the things, and I wrote about this, one of the things that I think is really, really disturbing about TikTok specifically is there's a bunch of data that they have supported Chinese companies to get favor in the algorithm. And so what was happening is, and a combination of AI, is these Chinese manufacturers, when they lost orders from US wholesalers, ended up cutting. The orders were cut and they were piling up all this product. When those US companies end up cutting, these Chinese manufacturers ended up realizing they could go direct to consumer. And they were using a combination of AI, language learning, video, and then all the data of all the specs. And they basically just copied and pasted all the marketing specs from the US companies. And there was a great study, the extensive amount of study that's been done this, and I learned this as I was writing this book, is that during that process is that there is countless examples of US companies, US brands, I can't pronounce it, Lululemon.
Lululemon.
Yes, thank you. I hate that term.
My daughter says it enough. I hear it enough.
They had a very specific example, but a bunch of other brands did as well, where they had product categories. There was something, the name was so similar to their own. And the Shein and Temu's were able to basically launch products that were almost identical, probably from the same factory, and marketed almost identical. And they had the benefit of all the data. And they were undercutting US companies. And I just found that to be fascinating. So I did this whole thing on de minimis. I think eliminating the de minimis exemption is the best thing that's happened in trade. Because the irony of this is these Chinese companies were not employing US employees, they do now, but did not have brick and mortar locations. It did not have US logistics networks. And they were just wiping out a lot of the companies that were selling into those communities. And so I think it's a pretty profound thing. So I'm willing to pay those taxes. And I think as an American, that is a tax that actually is justifiable.
Yeah, I don't disagree. I think this is probably beneficial for logistics networks, especially, well, at least the e-commerce companies that have logistics operations in the United States as it is today. It was going to, like anybody that invested in logistics networks here, certainly.
It does hurt FedEx. It does hurt UPS. FedEx has their
on
earnings.
The parcel side, yeah.
On the parcel side, it does hurt them. It really hurts the U.S. Postal Service.
Yeah.
From a volume standpoint. But the reality is the U.S. Postal Service wasn't making money on a lot of it.
Right.
It's the irony of it all.
But e-commerce companies with an investment in logistics here, I think, are going to do better.
Well, the reality is, like, a lot of the importers and a lot of the people that are in the customs brokerage are doing exceptionally well in this environment.
Right.
I think Ryan Peterson said something like his growth for Flexport, their customs business, is up like 99% year over year. And so I think it does benefit U.S. logistics operators. Consumers will pay slightly higher fees. But what we actually have seen, and the data supports this, is even where Temu and Shein have increased prices in certain categories, on an aggregate, what they've actually seen is, in some cases, the opposite, where those prices have come down to U.S. consumers.
Interesting.
To attract market share. And they pulled a lot of their marketing campaigns back initially. They're now back spending more money than they were last year. So we haven't lost Temu and Shein.
Interesting.
Awesome. This next question is a two-part question, so I'm going to read it slowly. Given the administration's proposal to shift public companies from quarterly to semi-annual reporting, how might this affect transparency, investor sentiment, and capital allocation in freight markets? With financial disclosures coming less frequently, what alternative data sources or mechanisms could investors and operators rely on to fill the information gap?
Oh man, I love this question so much. I'll take the first stab here. I actually am a huge believer in Warren Buffett. I was a finance person in college, and Warren Buffett was kind of my mentor from an educational standpoint from finance. And he came out in 2018 and said, him and Ray Dalio, I believe, said that a quarterly cadence is too often. And it certainly, I've even talked to your dad about this, and it certainly influences bad behaviors in business because it's, even though the idea of transparency is what it's supposed to be kind of fundamentally, how can you invest if you don't know what's going on? It still kind of forces businesses and companies to have a short-sighted target too often. And that is not good for long-term health for a lot of companies. Now, that being said, to the second question, alternative data sources, I'm a finance person and I work at SONAR. That's not a mistake. I love the data, obviously that we have, but there's, a lot of the stock market trades on this macroeconomic data that you and I just talked about, having so much flaw in it. And I personally have found, the discrepancies between some data and, our data and some of the macroeconomic stuff, mainly because of timing and lag.
Yeah.
So if you're accustomed to trading on macroeconomic data that's already 9 to 12 months out of date, missing a quarterly report here and there from an earnings call isn't necessarily, I don't think it's going to make that big of a difference in terms of that.
I have mixed views here. I think it is good for data businesses. The question was very clear. That what does it mean for all data?
Yeah.
I think it's great, frankly.
Fantastic.
It's better for our business. So from a selfish standpoint, it would be amazing.
Mm-hmm.
Right? What we do every day of providing visibility becomes much more important. Does it impact the capital flow of companies because there is less visibility potentially? Reason being that anytime your information is more opaque, is it's harder to understand where an industry's at for people who are outside of it or how to deploy capital. So it certainly could impact it. But I think it's at the margin. Am I generally supportive or negative? I don't know. It feels like a pretty substantial change. This is all governed by, I think, the SEC, Securities Regulation from the 1930s. This is something the president can want to do, and the SEC can make recommendations. They still need Congress to pass it.
Sure.
I don't know what the appetite is. I haven't explored it, but I don't know.
Yeah, I mean, I
a little bit outside of our domain. But
this is one that I feel strongly about. Okay. The value investor in me likes this one.
Great. I think we've got time for maybe one or two more. How should shippers and carriers factor the Fed's recent rate cut into their near-term planning?
I think everyone expected it was fully priced in, and I think if we do get more rate cuts, that will be bullish for next year.
Yeah, it's a 6 to 12 month thing before you even feel this in its full sense. So yeah, I mean, it certainly helps, but it's going to take more than 25 bips.
All right, and I will grab this very last one. What's the smartest move for carriers right now? Preserve cash, invest in equipment, or focus on contract stability?
It's a great question. I mean, I would say preserve cash because, even I've told you, I've stated that I feel better about where things are at. It feels more stable than it's been. This freight market is incredibly unpredictable. We are certainly on the back end of I like to think, and I think I'm right, this isn't going to go on for another 3 years.
No.
In terms of abysmal market. But I also think that every business should be focused on cash preservation. It's the only, you run out of cash, you're done.
Yeah.
You get to play at the tables as long as you have money, chips. If the chips are on the table and you have chips in reserve, you get to play. The moment those chips go away, you don't get to play.
Yeah, you got it. I mean,
my dad told me once, he goes, as a business owner, cash is king, but you get to, as long as you have cash, no matter what else matters, that everything else will be okay, because if you can get through the cash problems, you can eventually have time to recover. You lose cash, you're done.
Yeah, but don't get lost in the defensive mentality entirely. I mean, you obviously have to live there for the most part, but I think, there's more opportunities now showing up than there were, and you're going to have to be able to recognize them and take advantage when they occur. But I don't think we're at that point economically that we can say things are going to turn
I'm
dramatically.
sure our sponsor would love if you reached out to get, if you needed money,
Yeah.
Triumph will be happy to help you.
Keep that cash flow
to manage it.
going.
So.
Yeah, debt's about to get cheaper. So there you go.
Slowly but
Little
surely.
bit.
Excellent. Well, that is all the time that we have for today. A special thanks to Triumph for partnering with us today. Craig, Zach, thanks for being here this afternoon. It's always great to have you guys sharing your insights with us. Be sure to head over to live.freightwaves.com to get your tickets for F3, the Future of Freight Festival, taking place right here in Chattanooga, Tennessee on October 21st and 22nd. We are running a last chance sale this week for $500 off your ticket if you purchase before September 30th. And don't forget to mark your calendars for next month's State of Freight on October 16th at 2 p.m. Eastern Time. Thanks again, everyone.
Incredible atmosphere, but this